This advice is general and does not take into account your objectives, financial situations, or needs. You should consider whether the advice is suitable for you and your personal circumstances. Before you make any decision about whether to acquire a financial product, you should obtain and read the relevant product disclosure statement. Welcome to our GFM Wealth Podcast. My name's Patrick Malcolm. I'm a senior partner at GFM. I'm joined by James Malliaros, one of our senior financial planners. Welcome, James.
Thanks, Patrick. Good afternoon. Good to see you.
You too, James. And we're also joined by Leo Barry from Fairview Equity Partners as well. Thank you for joining us, Leo.
No, it's very much looking forward to the discussion.
Good. Now, there's a really, really big elephant in the room that we need to deal with. Yeah. That's really important. Paul insisted that we ask this question. He's a big Swans fan, but obviously most people, or almost all the people that would be listening, know of you as an ex-AFL footballer.
I thought about a financial advisor or market animal or something like that. Isn't that where you go? Yeah.
You can't hide.
No.
One of the more iconic commentary moments from Steve Quartermain. No, we won't repeat it. Yeah. But the transition from your AFL career to financial markets, let us know how that transpired.
Footy's, that's the only thing I wanted to do growing up as a kid, and managed to play 15 years of footy, and it was an amazing experience. We had a lot of success there at the Swans, learned a lot of lessons, which you still apply to what we do today. And I suppose whether you play 2 years or you play 10 years in football, it's that transition away from sport it can be really difficult. And so for myself, I learned pretty early that footy's great and everything, and it can finish really, really quickly. And so studied for about 10 years, got through about 3 degrees, and just always was worried about the next transition of my career and also all my life, and also having young children at that stage as well. You had to have people that are relying on you. It's one of those things that really drove me. And Citibank were one of our major sponsors at the Swans, and spent 4 years, sort of nearly 4 years. Every time I had a day off, I'd go in and sit on their institutional desk and just love markets and just the dynamic element to it. And that was 15 years later. I've been at Fairview for nearly 12 years and spent 5 years at Merrill Lynch. So time flies.
Pretty seamless and easy.
It feels like it, but it's footy's really it's a tough industry, and that transitioning away can be hard as well. So really happy how it's gone, and really enjoy what I do today.
We've got quite a few new clients who have just gone into the Fairview investment, and a lot of clients aren't unfamiliar with Fairview. Tell us a little bit about the business. Yeah,
so Fairview is probably one of the longest running small cap funds in Australia. Yeah, it would be definitely in the top sort of 3 or 4. Melbourne-based fund. We're 100% retail. We don't have any institutional money. We're running circa. It's around that sort of 600 to 800 is our sort of key range, and you can't run a fund too big just due to liquidity and the ability to move your portfolio around. And so for us, we have about 50 stocks in our fund, and you may say that that might be a longer tail, but for us, you make your good returns from your top 10 positions, and just due to liquidity and the size of a position, that allows us to own a bit of a longer tail of some of these sort of earlier stage stocks. And so, the fund's been running for the 18 years. We're probably in the top quartile over, every duration, 3, 5, 10, 15 years, which we're really proud. And, we have a really, really strong investment process. We have our own money in the fund as well. And so it is one of those real vested skin in the game, and you have to have a vested interest. But there's only 3 of us, 3 portfolio managers and also owners of the business. And, you got to love markets, and you got to look at every sector. And probably one of the key areas at the moment, which some of our peers don't do, is we invest in resources, and that's been one of the best returning segments for us in the fund over the 18-year journey.
Linking back to tenure, Leo, I think your investing career is about to catch your AFL career by the sounds of things.
It is.
15.
Yeah.
The biggest lessons that you've learned by being in markets from that time, can you talk us through those?
Yeah. It's interesting. I suppose we have at Fairview, you have a sort of stringent investment process, which and it's a bit like sport in some respect. If you don't stick to a recipe for success, it makes it really, really difficult to get returns. And I suppose for us, we stick to our a strong investment process, and we do our one page investment thesis. And so for us, we we often don't buy a stock and it'll go in our top 10. We buy slow and we sell fast, and that's probably the key lesson for us. Stale ideas is probably the detriment of any portfolio manager's numbers. And when you have stale ideas or a stale portfolio, more often than not, it's those ideas that you'd have probably less conviction on that can ultimately really impact the return of the fund. And so if our investment thesis is degraded, we subsequently either reduce the weighting in that particular stock, or on the other side, if we have a high conviction around a potential catalyst that may re-rate or potentially derate the stock, we move really quickly.
Okay.
And so when we're running, circa 600 to 800, we have the ability to liquidate our fund, and we could probably liquidate a whole fund in circa 30 days. And there's probably not many other guys in the industry that could do that. And so that liquidity element's really, really important.
Over the 15 years, what sort of changed the most since you started all those years ago, do you think, in the way that we've been invest?
I think it's what we're being experienced at the moment. Yes, we are bottom-up stock pickers. We do 600 meetings a year with CEOs of companies all across Australia, which it's pretty cool. You get to meet some really inspiring people, but also you have to, other people maybe don't have a bit of a black book or cross across their name. So that more often than not, you have to be really, really cautious around potential people and also their strategies.
Yeah.
But definitely, we're a little bit more mindful of the macro. You just can't not be. I suppose since we've gone through COVID, just with the
geopolitics, all that kind of stuff,
geopolitics
all that stuff,
war and everything like that, it's probably made us a little bit more macro, mindful. We don't try and predict where the gold price is going to go in oil, and you can get yourself wound up in knots trying to predict that.
Yeah.
But we just try and pick the better companies that have the better forecasts, and especially in the commodity space, low end of the cash curve, good jurisdiction, really good grade, and more often than not, those things will outperform some of their other peers that are also listed.
So that impressive long-term track record that you speak about, Leo, I guess we could argue that you guys have an edge.
Yep.
What do you see as Fairview's edge? I know we've sort of picked up on some of these points so far with the exposure to resources and your size and capacity and all these through, but where do you think that comes from?
I think it's just time in markets. That's one experience. We've had a lot of one particular year we had a really, really difficult period and underperformed by a double-digit amount. And what we learned from that, and that sort of comes back to that the liquidity limits on a lot of our stocks and also our positions. So that's something we've changed. All three years have had north of 20 years experience in markets, but importantly, we also all worked on the sell side. We worked at I worked at Merrill Lynch before and Citibank. Tim Hall, he was at Credit Suisse, and Ben Chan, who's been at the firm for a couple of years now, he was a number one rated analyst at Merrill's, who I also work with as well. And so having that experience on both sides, it's really the information you pick, you understand how investment banks work, to the positive, also the negative.
Of course.
IPOs, we're generally really, really cautious on IPOs. More often than not, there has to be a reason why they're either coming to market. They've obviously potentially been a large sell down, or they've just had a wave of like some of the retail sales numbers, as an example, after COVID. You saw a lot of companies listing, so you're always really, really cautious of that. And because of our experience on the buy side as well, it gives us a real rounded level of experience. And we're all really inquisitive, and that's part of the job. You can't just sit there and put a line through a particular stock just because you've had a bad experience. We're all constantly just going around seeing new ideas, kicking tires on other stocks, which maybe something's changed. And really importantly, you have to. There's some stocks that we've been following for 8 years, and we haven't invested in. There's a name Wagner's, it's WGN's a ticker. And so we've been following it. Liquidity hasn't been quite there. And so you always have to continue to follow and retest all your old thesis on a particular stock, and things can change pretty quick.
Based on all the experience that you've had and all the different circumstances with markets, are there things that when you're investing in a company for the first time, are things that you look at, like indicators that sort of point to whether it's worth investing in it, or whether you just sort of stay away because there's just, there's alarms going?
Yeah, if you can't, and so I sort of alluded to previously with our one-page investment thesis, if you can't put it on one page, the key drivers either for a business to either exist or have a competitive moat, then it's not worth looking at. We do all our own sort of internal analysis of a stock. We obviously get a lot of broker research, probably too much, to be honest. It can get really, really noisy. But if you can identify the key 3 or 4 key reasons to buy a stock, then we obviously do a larger investigation onto the stock, and then potentially, and for all the of the 50 stocks we have in our fund, there'd probably every year there'd be probably 20 or 30 stocks that don't get in the fund every year, where we get to that final investment decision, and it's probably not quite ready for the portfolio. And so with that work you're doing, you're always continually looking at new ideas, and this is the beauty. Like my 2 colleagues are over in Perth at the moment. They'll see probably 30, 40 resource companies just in a couple of days over at a large conference over in Perth, and that's the beauty. We're all generous, and we look for stocks that are from aged care to resource stocks to retail stocks. So you jack of all trades. I might say master of none, but we try and do our best. But it's the ability to have a broad range and a knowledge around a lot of sectors, and because we're all generous, we find that really tends to work. And because there's 3 of us, we have to vote on a particular stock, and it's a real team environment in some respects, and that's really important. We don't have just one portfolio manager with analysts feeding ideas up. We're all at the same level, and that's really important because you have to have ownership of each stock that's in your fund, and ultimately we're business owners, and we have to work for and with each other to get the best returns. And I think we've proven that over a long period of time.
So easy, James. 3 or 4 key ideas all down on a page, and the numbers will look after themselves.
That'd be great, wouldn't it?
Yeah.
It's easy,
Now, you spoke about this black book of corporate Australia before, which I know you've mentioned Invest. Leo, we're not going to put you on the spot. But I guess the issue of management, quality versus valuation, and can you justify paying, I guess, a higher multiple for a company with a better management team?
Probably there's one stock that comes to mind, and we were a successful investment in that, was Pro Medicus, PME. And that's probably a really good example of really good management. The multiple of this stock was on circa 80 to 100 times PE for the whole journey. So this is Pro Medicus. They encrypt all the data, and they can shrink the data down for a lot of the MRIs. And the amount of data from 3D imaging from the hospitals has just exploded. And so they have to store this somewhere. And so with this encrypted software through PME called Visage, they're able to squash down the ability to have basically manage as much data for a lot of these scans. And scan volumes are just exploding. And so in an Australian business, they only have about 25 to 30 employees. It's quite extraordinary business.
Office just in Richmond.
That is exactly right. And actually, there was a stat. It was the most successful company in the world for revenue per employee globally. It's staggering.
Really, yeah.
So hence, this stock always traded on a massive multiple. We eventually had to sell it probably only about 12 months ago. It went into the top 50, and it was at $380, and it was still trading on 100 and something times PE. We had to sell it, but and which was probably the right decision. Because the stock's down to about 110 now. But fantastic business. So to my point, you back the person, especially in small caps. Your listeners might be aware that REA, car sales. These are top 50 stocks.
All the small cap stocks.
They all started at small caps, and we've got some fantastic business.
Ramsay Healthcare, I think.
Ramsay Healthcare, Lend-Lease. There's a lot. Aristocrat, and so the ability to identify these stocks that have real structural tailwinds, high ROE businesses, really good management. They're out there, and more often than not, they're really compounding businesses, and that have a real edge. And that's the secret sauce for us. You have to identify those businesses early, and hopefully ride the success. And I think we've got a few more in our portfolio at the moment.
Elaborating a bit on that. There are some great businesses out there, but not necessarily great investments. So, you sort of what your thoughts around that? Maybe a couple of examples. Maybe.
Oh, look. Sometimes you look at some great investments. Really capital-intensive businesses are sometimes hard. And so that might be great investment depending on how the return of the share price. So that probably elaborates in whether it's a great investment. But ultimately, those really high capex businesses that are low margin, and in particular with when they're low margin, the room for error is really, really thin, and sometimes you can come out with significant downgrades if something does structurally change in a particular business. And And also, if you have a physical asset, there's nothing stopping a competitor building exactly the same infrastructure in the same position. So those sort of business we try to avoid. The real capital intensive business, but we still do continue to have a look at them.
Okay.
So it's been interesting, Leo, for a little while in Australia and globally too. We've had this phenomenon of large caps outperforming small caps, and there's been periods of time recently where that's reversed. Obviously, small cap returns for last financial year were quite strong. Where do you think the opportunity set is in the small cap universe at the moment?
Yeah, it's looking really interesting. We've been talking about this for probably since COVID. The top 100 basically outperformed by circa 35% until last year, and we've sort of been continually talking about it. You sort of need a couple of things for reason for small cap to outperform. And we saw a bit of that last year. So small's actually outperformed by about 16%, but subsequently that's unwound just due to the Iranian issue, and war. And now people are talking about higher inflation, which is higher inflation creates higher interest rates and the impact that has on valuations with
also on small business,
especially in small business and small caps as well. And so subsequently, it's been a pretty difficult sort of 6 months on a relative terms, but clearly what happened today with the deal being done with Iran, they're going to clear the strait, hopefully get energy pricing down as well, and clearly also with the amount of tariffs that Trump have put in have been inflationary. And so despite all those sort of headwinds, it has underperformed, but I think they're all starting to thaw. And subsequently, when you do get a bit of calmness in markets and people are starting to really chase, the EPS growth and revenue growth in small caps is superior to the top 100. I suppose people, when markets are really few, everyone generally pushes back into the top 100 just due to liquidity, they hide in the banks.
Budget security and everything like that,
But it's interesting at the moment, everyone's been, despite a lot of the banks having very, very little EPS growth, and also just with the current budget, what occurred there with credit growth as well, with the reduction in negative gearing, the impact that'll have. I think we're getting a bit closer to potentially the small caps outperforming, and also the resource sector. It's I think we might be in a really strong cycle here for resources. Just the lack of investment that's occurred across the whole commodity space, and this the AI and also this EV thematic and infrastructure changes with the electrification globally. I think there's going to be a massive uptake in copper, nickel, zinc, aluminium, and also those particular sectors that are linked to the EV thematic are only going to continue to go from strength to strength.
That's where you're seeing most of the opportunities in the small cap sector around resources, EV. Any other areas maybe you're thinking?
Oh, the data centers, isn't this? This is something, the data center capex. And so what we've seen in the US, number one, there's been the amount of data rollout has been absolutely extraordinary just over there, over in the US. They're having power issues as well. And there's been some of these data centers and some of these AI companies are actually doing nuclear deals with physical uranium. So they may be able to put in these small reactors, which that could be a possibility. And so Australia's probably about 3 or 4 years behind this sort of capex spend on data centers, but it's just happening now. So I heard something today. I think the next 12 months, because one of our companies is actually raising today, Southern Cross Electrical. And so the capex is going from 1.1 gigawatt for this year, and it's basically going to triple over the next 2 or 3 years.
Wow.
And so we can actually get exposure to that capex. So we own 3 names that actually do a lot of the electrification, also the substations. So Southern Cross Electrical, SXC is its ticker. It's been a really good investment for us over the last sort of 12 months. The other one is Genus Plus, which basically with all the wind and also solar, utility companies are basically have to re-engineer a lot of this the power infrastructure, and so they do a lot of the power poles. And the final one is Mars Group. They're also doing a lot of the electrification as well. And so the amount of drawing on the amount of power, but also the infrastructure spend, it's almost like a resource boom in the AI capex. So that's definitely an area where we're seeing some really good opportunities.
Interesting. And you talk about all these company visits that you do, Leo, in a year, which I'm sure you get sick of from time to time, but nonetheless. Could you maybe give us some examples of some things that you're hearing from management teams that perhaps ordinary investors don't get to hear about sitting at home?
Just in the current market.
Yeah.
Yeah.
What themes are coming through at the moment as you speak to company management?
Yeah, well, we were at Macquarie conference, which was in May. It's just interesting, just the rhetorics, even just domestically. Everyone's been sort of talking about a difficult economy in Australia, and it's probably just got a little bit worse.
Yeah.
Just foot traffic from all the retailers has dropped like a stone in April, May.
Yeah.
So we're really cautious retailers and also the consumer discretionary names here in Australia, and we've sort of been a bit underweight those names over the last probably couple of years, and we don't see any of that alleviating. It's interestingly even just the rhetoric in the market now. Everyone was expecting interest rate rises to occur, but at the back end of this year, there's a potential for interest rate cuts, that's something that's definitely changed over the last probably 2 or 3 weeks, and some of the sentiment around that. Clearly the budget was a bit of a sticker shock for everyone, but also just the sentiment change domestically.
Or confidence and stuff like that.
And that's that's where the economy really runs off.
Yeah.
And also, people put their hands in their pockets, and even some of the domestic builders that we've been talking to as well, and even just general trades, in particular, just in Victoria, it's really, really dropped.
It's tough.
And it's become really, really difficult. It's funny, the economy is sort of split. Queensland's booming, WA's booming, and that's the majority of that is off the net migration, but also the resource sector. You're seeing really, really strong commodity prices, WA iron ore, but also the gold, and property pricing in also Queensland and WA are still increasing, while the rest of Australia's been really subdued.
Everyone's sort of employing AI for business efficiency. Obviously, it's been a big thematic around the year. Some of the biggest companies in the world are spending, hundreds of millions of dollars on trying to make their businesses more efficient using AI. Has AI changed the way that you look to invest or the way that you research businesses?
Yeah, it's a good point, actually. Yeah, we're definitely using tools. Look, Claude and Chat, they're helpful. They're helpful to some extent when you're just doing some initial research. You have to fact check everything.
Of course you do. Yes,
that's the key.
That's your reputation, isn't it? Yes.
But also definitely just with a consolidation of research for us. Like we get so much research, the ability to consolidate down transcripts is obviously something that we can scrape all the data. Just a change in tone. Also, just a change in messaging and rhetoric, you can sort of pick up. And it's like when you follow companies so closely, we can just identify those little changes. And it's one of those little soft skills that it's really important for our returns, but also just identifying when things do change. But also, just scraping data for a lot of their offshore relative peers. So when you see certain thematics occurring in Australia, more often than not, they may be occurring somewhere in another country, which the data centre one is clearly one which has happened overseas as well. I suppose for us, it's always a question for us to the company as well. And you've seen it probably over the last 6 months. We've been overweight the IT sector, and that's been really soft because people are worrying that this AI is going to disrupt them. So we're really, really mindful about that. It's probably a little bit too early to say that, but one particular company, we think it'll be a net positive for it. It's Megaport, and they just raised some capital just recently. It's been a really good performer, and so they basically interconnect data centers when people are doing a high volume data transfer. But more importantly, they just bought another business which basically it outsources computer sourcing and also computer technology, and so it's a highly capex business. But just with the amount of data and also the use of AI and also a lot of these data centers, they're basically the traffic way for potential companies to move around their data on data centers. So there's ways
have definitely kicked off over the last couple of months.
It's been really
the capital
really
raise was huge.
But it'll also be an enabler, and it'll make a lot of businesses a lot more efficient, especially if you have a cost to serve, or you have a large service industry or a service you can automate some certain stuff. Call centers that could be certainly disrupted, or make businesses a lot more efficient. But you're
seeing that
it's an ongoing
through to company results yet?
No, not quite yet. No. A lot of stocks have been moved around a lot, probably on the negative side in the IT space, but no one of the companies we've spoken to, it's probably just been a little bit early for it. can it disrupt the insurance agency? Can it disrupt the leisure?
Yeah.
The travel industry? We don't quite know yet, but I think we'll get a better idea over the next 12 to 24 months.
Yep. Tricky question. What's the market getting wrong at the moment, Leo? So whether that's a sector that you think looks expensive or looks extraordinarily cheap, where do you think things are sort of out versus fundamentals at the moment most?
I think the resource sector is probably one which I think a lot of people still aren't. I think the market's underweight that, especially in a lot of our peers. As I alluded to, 3/4 of our peers don't even do resources, which I find staggering. And not owning resources, 8 out of the 10 years, it might be a net returner for your fund, but those other 2 years, which I think we might be in a super cycle for resources. So the backdrop, just what I've referred to, just around the EV. The electrification of globally, the drawdown and the lack of investment in some of these new, whether it be gold or copper, it's very, very difficult. And basically everyone's had reducing production globally in most commodities. So it's setting up for a real bull market in commodities and fundamentally in some of the resource names.
Yep. So this perception of everything in that small cap space being a penny dreadful miner is a long way from the truth.
Yeah, no, there's some really good companies. I suppose for us, we try not to just. They have to. Most of the companies we invest in, they have to be producing or being close to producing. We don't take punts on just on the drill bit. Drilling out a resource, trying to find something. It's very speculative. So if you have those those real stringent framework around investing in resources, you got to make sure you meet management and also get out and talk to a lot of companies as well. That can often really mitigate some of the risks you can have. But we try and steer clear of the penny dreadfuls.
No, fair enough.
Yeah. The retail investors had a little bit of a hard time over the last sort of 6 or so months. Markets have been really quite volatile. Do you think there any particular that retail investors, that where the biggest mistakes where they make in terms of trying to sort of pick stocks, particularly in the small cap sector?
Advice. It's advice. Yeah. I suppose you can do your own research. But sometimes when you're not involved in the market, there's also information that you don't get. And so I suppose the benefit we get access to management and companies. You can do all your desktop research and even in our job, but there's a lot of information you don't get. And so having advice or not taking a stock tip from someone, it's got to be something you have to be comfortable of, but also have the confidence around the management, the strategy of the business, and there's sort of some of the questions we're allowed to obviously ask on an ongoing basis. So probably the best question for retail partners, get advice before investing and
don't take the barbecue.
Don't take the barbecue, and diversify yourself through funds. That's probably the less.
Well, we see it as a specialist asset class, Leo, and that's why we outsource it to Fairview. Final question: what are you watching closely right now that isn't getting enough attention in markets?
It's a very good question. It's probably in our sector, a lot of the really interest rate sensitive stocks, like a lot of the REITs, have been really underperformed, and also some of the financials. So generally, when you have a higher interest rates, the cost of funds can really get really blown out, and also a lot of the higher leverage stocks. Generally, in small caps, some the ability to raise money, that can also be an issue in higher interest rates. But clearly, if the setup we see at the moment, I think there's a potential for interest rate cuts at the end of the year. So the REITs is about sort of 15% of our index. They've really significantly underperformed, but that's probably one sector. It's a pretty boring sector, but it can move really, really fast. And often you see if you can get decent dividends, with the banks or even your term deposits, if it's similar to the dividend yield for a lot of the REITs, more often than not that money doesn't flow there. But I just think at the moment that's probably a sector that's a bit unloved, and there are certain segments in the REIT sector that have been really, really underperformed, and the office is probably one. We're steering clear of office at the moment, in particular down in Melbourne. I think we've still got 40% vacancy rates, and I don't see that changing anytime soon. But there are some more buoyant areas.
So retail and industrial?
Retail and industrial, they're probably the two better sectors that we look at. And we often try and invest in a lot of the fund managers like Charters, CHC, and also CNI. So they basically run like a fund manager, and they can they can clip in some respects, like a performance fee, like a fund manager, and also get a larger distribution. So we have a preference for a few of those names.
Okay.
Right. Yep. Leo, really appreciate your time today.
No worries.
Thank you for joining James and I.
Thanks for the
Leo.
interest.
Appreciate it. It's
Thank you.
fantastic. Thank you.